Your job as a trader isn't to trade. It's to wait for good trades and then execute them well. I know this sounds completely backwards. You want to make more money, so you should trade more, right? More opportunities, more profits. That's what everyone thinks when they start. I thought that too. But here's the big difference between profitable and unprofitable traders. They've figured out that trading is the only profession where doing less work actually makes you more money. And I'm going to show you exactly why with math, psychology, and cold hard reality. Let's start with fees. Every time you enter a trade, you're starting at a disadvantage. And I mean every single time. Think about it. Before your trade even has a chance to move in your direction, you've already paid the spread. You've already paid the commission. If you're trading futures, you've paid exchange fees. If you're trading options, you've paid more spread than you probably realize. Let's put real numbers on this, because most traders never actually do this math. Say you're trading Forex with a typical broker. The euro to US dollar spread might be 0.8 pips. Doesn't sound like much, right? But here's what that actually means. On a standard lot, that's $8 you're down the moment you click buy. You need the market to move nearly a pip just to break even. Now multiply that by 20 trades a week. That's $160 a week, $640 a month, over $7,600 a year, just in spreads. Before the market even moves. Before your analysis matters at all. And that's if you're trading Forex, which has some of the tightest spreads in the game. Now, let me show you something even more disturbing. I analyzed 100 trading accounts. Real account from a broker that shared anonymized data with researchers. You know what they found? The accounts that traded the most had the worst returns. Not just a little worse, dramatically worse. The top 20% most active traders lost an average of 8% per year. The bottom 20%, the ones barely trading, lost only 2% per year. And the tiny group that was profitable, they traded 70% less than the average account. But it gets weirder. When you look at just the profitable accounts, the correlation gets even stronger. The less they traded, the more they made. Why? Let me give you 3 reasons, and the third one's going to change how you think about trading forever. Imagine your strategy has a real 3% annual edge once you account for your win rate and risk reward. Solid, clean, nothing unrealistic. Now layer in transaction costs. If your average round-trip cost is 0.5%, and you take 200 trades a year, that's a 100% cumulative cost load over the year. And no, that doesn't mean you lose 100% of your account. What it means is this. You're applying the equivalent of an entire account's worth of drag against an edge that only produces 3% a year. See the problem? Your edge is tiny. Your cost base is massive. The math doesn't even let the edge breathe before the costs suffocate it. And it gets worse. That 3% edge isn't the same on every trade. Some setups have real edge. Some have thin edge. Some have no edge. Some are straight up negative, but the 0.5% cost hits every single one of them equally. So when you trade too often, you're doing 2 things at once. You're multiplying your cost drag. You're mixing high-edge trades with low-edge garbage. The result? Your noise grows faster than your signal. Your expectancy collapses. And the system that looked profitable on paper gets shredded the moment you start overtrading it. Every trade you take depletes your mental capital. You've probably heard about decision fatigue. Obama wore the same suit every day. Zuckerberg wears the same shirt. It's not about fashion. It's about not wasting mental energy on decisions that don't matter. Traders do the opposite. Every trade is a high-stakes decision under uncertainty. And your brain isn't designed to make hundreds of these well. There's research on this from medical fields. When surgeons perform multiple complex operations in a day, the quality of decision-making measurably declines. Not because they're less skilled, but because the human brain has limits. You're doing the same thing. Take 20 trades in a week, and by trade 15, you're not seeing the market clearly anymore. You're seeing what you want to see. You're finding patterns that aren't there. You're taking trades that you wouldn't have taken when you were fresh. And here's what makes it worse. You don't notice it happening. Decision fatigue doesn't feel like fatigue. It feels like clarity. You feel like you're seeing opportunities. Your brain is actually just lowering its standards because it's tired of the hard work of saying no. The best traders I know treat their attention like a limited resource. Because it is. They might scan the markets every day, but they're only really engaged, only really analyzing deeply a few times a week. The rest of the time, they're waiting. Which brings me to reason 3. This is the big one. The market doesn't care about your schedule. Think about what you're actually doing when you trade frequently. You're imposing your schedule onto the market. You're saying, I'm going to find 20 tradable setups this week because that's my plan. But the market doesn't produce 20 good setups every week. Some weeks it produces 2. Some weeks it produces 0. Some weeks it produces one perfect setup that's so obvious you'd have to be blind to miss it. When you commit to frequent trading, you're not actually trading the market anymore. You're trading your need to trade. More trading doesn't mean more opportunity. It means lower standards. Think about it in any other context. If you're hiring for a position and you decide you need to make a hire every week, you're going to hire some terrible people. But if you say you'll only hire when you find someone exceptional, you'll build an incredible team. Dating works the same way. Investing in businesses works the same way. And trading works the same way. The edge doesn't come from finding more setups. The edge comes from waiting for the setups where everything aligns. Let me break down what actually happens in your brain when you overtrade, because this is fascinating. There's a concept in neuroscience called prediction error. Your brain is constantly predicting what's going to happen next. And when reality doesn't match the prediction, you get a prediction error signal. That signal releases dopamine. And here's the kicker. You get more dopamine from unpredictable rewards than predictable ones. It's why gambling is addictive. It's why social media is addictive. And it's why trading is addictive. Every time you place a trade, you're buying a lottery ticket. You don't know if it'll win or lose. And that uncertainty feels exciting. It feels like opportunity. But you're not trading for opportunity anymore. You're trading for the dopamine hit of uncertainty. The less you trade, the less you trigger this cycle. You give your brain time to reset. You stop chasing the feeling and start chasing the opportunity. Now let's talk about what actually makes money in trading, because it's not what most people think. Most people think trading profits come from being right about direction. You think the market will go up, it goes up, you make money. Simple. But that's not how professional traders think about it at all. Professional traders think in terms of edge, position sizing, and trade selection. And trade selection is the most important of the 3. Here's what I mean. Let's say you have a strategy that wins 60% of the time with a 1.5 to 1 reward-risk ratio. That's a solid edge. In theory, you should make money. But now let's say you take 100 trades with this strategy. Because you're taking so many trades, some of them are A-plus setups, some are B setups, and some are C setups that barely meet your criteria. You're averaging them all together. Your A-plus setups might win 75% of the time. Your C setups might win 45% of the time. But you're treating them all the same, risking the same amount on each, because they all technically fit your rules. What if you only took the A-plus setups? Let's say that's 20 trades instead of 100. You just cut your trading by 80%, but your win rate jumped from 60% to 75%. Your expected value per trade just skyrocketed. Plus, you're paying 80% less in costs. You're experiencing 80% less decision fatigue. You're waiting for 80% better opportunities. This is the secret. The best traders aren't better at analysis. They're better at waiting. Let me show you this from another angle. Warren Buffett has a famous thought experiment. He says, imagine you get a punch card with 20 holes in it, and that's all the investments you get to make in your lifetime. Every time you make an investment, you punch a hole. Would you invest differently? Of course you would. You'd be incredibly selective. You'd only take the no-brainer opportunities. Now, Buffett is talking about investing, not trading. But the principle is the same. Scarcity forces quality. What if you gave yourself a punch card with 50 trades for the year? That's about 1 trade per week. Would you take different trades than you're taking now? Would you wait for better setups? I guarantee you would. And I guarantee your results would improve. Here's something else that happens when you trade less. Your risk management automatically improves. Think about why people violate their risk management rules. It's usually not because they don't understand the math. It's because they feel like they need to make back losses, or they're on a hot streak, or they haven't traded in a while and they're eager. When you're trading 20 times a week, you're constantly in one of these emotional states. You just took a loss, so you're in revenge mode. Or you just took a win, so you're feeling confident. You're always reactive. When you trade once a week, you have 6 days between trades to emotionally reset. You're not trading from emotion. You're trading from analysis. Let's talk about drawdowns, because this is where overtrading really kills accounts. Every trader has losing periods. It's inevitable. The question is, how bad do your drawdowns get, and how quickly do you recover? When you trade frequently, your drawdowns get worse for 2 reasons. First, you're paying more in costs, so it's easier to slip into a losing streak. Second, you're more likely to overtrade your way deeper into the hole. You take a loss, then another. Now you're down 5%. So you start looking for trades to make it back. But you're not looking for good trades. You're looking for any trades. You take 3 mediocre setups, 2 of them lose, and now you're down 9%. This is the overtrading death spiral. The more you lose, the more you trade. The more you trade, the more you lose. Compare that to a trader who only takes 1 trade per week. They take a loss. They're down 2%. The next week, they wait for a good setup. They find one. They take it. It wins. They're back to break even. Drawdown lasted 2 weeks, never got below 2%. The math here is brutal. A 10% loss requires an 11% gain to recover. A 20% loss requires a 25% gain. A 50% loss requires a 100% gain. The deeper your drawdowns, the harder it is to climb out. Trading less keeps your drawdown shallow. Shallow drawdowns are easy to recover from. Deep drawdowns destroy accounts and careers. Now, I know what some of you are thinking, but what about day traders? What about scalpers? They trade hundreds of times and make money. Let me address this directly. First, the vast majority of day traders and scalpers lose money. The statistics on this are brutal. Over 90% of day traders lose money over the long term. The ones who make it are exceptional, and they have advantages you probably don't have: better technology, better infrastructure, better information, or they're providing liquidity and making money from rebates. Second, even successful day traders are incredibly selective within their style. A scalper might take 10 trades in a day, but they're passing on 100 potential setups. They have razor-sharp criteria. They're not just trading because the market is open. But here's the real point. Even if you want a day trade, the principle still applies. The best day traders take fewer trades than struggling day traders. The selectivity principle scales to every time frame. Let me give you a framework you can actually use. I call it the traffic light system. Green light trades are the absolute best setups. Everything aligns. The trend, the support resistance, the volume, the market context, your risk reward. These are the trades where you'd be willing to risk 2% or 3% of your account because you're that confident. Yellow light trades are good setups. Most things align. You'd take them, but you'd risk less, maybe 1% of your account. Red light trades are everything else. They sort of fit your strategy, but something is off. The context isn't perfect. The risk reward is okay, but not great. Here's the rule. Only take green light trades. That's it. Everything else is a pass. Most traders take green, yellow, and red light trades because they want to be active. But the yellow and red trades are where you lose money. They're net negative expected value once you factor in costs and psychological wear. If you only took green light trades, you might trade 80% less. But your win rate would spike. Your average winner would be bigger. Your confidence in each trade would be higher. Your costs would plummet. This is how you stack the deck in your favor. Let's talk about one more thing: opportunity cost. Every trade you take has an opportunity cost. The money you have in that trade can't be in a better trade. The attention you're giving to that trade can't be given to finding a better trade. Overtrading locks you into mediocre opportunities and blinds you to exceptional ones. I see this all the time. A trader has 5 open positions, none of them particularly great. Then a genuinely incredible setup appears, the kind of setup they dream about. But they can't take it because their capital is tied up in those mediocre trades. Or worse, they take it anyway, over-leverage their account, And when one of those mediocre trades goes bad, they get margin called or stopped out of everything. If you're always in trades, you're never available for the best trades. The best traders are always available. They have dry powder. They have mental bandwidth. When the perfect setup appears, they can load up and take full advantage. The analogy I like is a photographer waiting for the perfect shot. You could take 1,000 photos hoping some turn out okay. Or you could wait for the perfect light, the perfect moment, the perfect composition, and take one stunning photo that's worth more than all those mediocre shots combined. The market works the same way. You're not getting paid for volume. You're getting paid for quality. Let me bring this all together with a challenge because I want this to be actionable for you. For the next month, cut your trading frequency in half. Whatever you're doing now, do half of that. If you're taking 20 trades a week, take 10. If you're taking 4 trades a week, take 2. But here's the key. Don't just randomly skip trades. Rank your potential setups. Force yourself to only take the top half, the ones where everything really aligns. Track everything. Track your win rate. Track your average winner versus average loser. Track your costs. Track how you feel about each trade before you take it and after it closes. I'd be willing to bet you 3 things happen. 1. Your win rate goes up. Not a little, significantly. 2. Your average winner gets bigger relative to your average loser because you're holding positions with more confidence. 3. You feel less stressed and more in control. And here's the 4th thing that might happen. You make more money, even though you're trading half as much. Because trading isn't about how often you pull the trigger. It's about what you're aiming at when you do. The traders who make real money, the ones who last decades, who compound their accounts, who actually achieve financial freedom from trading, they all figured this out eventually. They figured out that the market rewards patience, not activity. It rewards selectivity, not frequency. It rewards discipline, not enthusiasm. The market is always going to be here tomorrow, next week, next year. There will always be another trade, but there won't always be a good trade. Your job isn't a trade. Your job is to wait for good trades and then execute them well. Most traders have that backwards. They think their job is to trade and waiting is what they do in between. But the waiting part is in fact the job. The trading is just the part where you collect your paycheck for waiting well. So stop trying to trade more. Start trying to trade better. Start trying to trade less. Because I promise you this, the less you trade, the more clearly you'll see the market. The more clearly you see the market, the better your decisions. The better your decisions, the more money you make. It's not complicated. It's just hard because it requires patience. And in a world where everything is instant, patience feels like doing nothing. But in trading, patience isn't doing nothing. Patience is doing the most important thing. It's the difference between gambling and investing. It's the difference between hoping and knowing. It's the difference between trying to beat the market and letting the market pay you for being patient. So here's my final message. Trade less. Make more. It's that simple and that difficult. If you found this valuable, let me know in the comments.